Good morning, folks. Well, this is a classroom, so I'll try one more time. Good morning, folks. Well, it's a little bit better. We're not used to seeing so many people live. It's so nice. We're trying to figure out, compared to the last couple of years, why more people came. And maybe the morning time. Do you like morning time more than afternoon? We've always been doing this from 2 to 4 p.m. Maybe the markets are a little bit better. Everybody's a little more excited. Wants to learn, wants to stay in the game. Hey, Michael, how you doing, man? Good to see you. Okay, welcome everybody to our Annual Regulatory and TSX Venture update. Very happy that you've come. See lots of familiar faces and some new ones too. Today we're gonna go over basically sort of what's going on in the marketplace from the different perspectives, including the auditing firms, the Securities Commission, the audit regulator, and the stock exchange, to kind of give you a different perspective of what they've seen, what we think is relevant, and what we think is gonna get out there in 2026. One thing for sure, for those of you who are in mining and metals, it's a super exciting time. I think it's gonna last for a while. So 2026 would be a great year to focus again, stay healthy, because the last couple years have been a little bit slower, and it's a good time to sort of go back to good habits in order to make the best of what hopefully this lasting mining market will last for. Hope you like our new branding. Those of you who came to our cap party saw it. You'd know we're Davidson LLP for a long, long time. We went through a transition of the firm over the last couple of years. We like the Davidson name. I hope you do too. And we thought that was important to keep, but we did put a little bit of a refresher. We shortened it a bit, colored it up, also a little bit closer to our network Nexia, as we form strong relationships with them, and we use them for a lot of our mining clients around the world. So I hope you like it. So we got a great lineup today, many faces that you've seen before. Jeremy, just here to my left, has actually participated in an event with us some time ago, maybe 15 years ago, or 10? Maybe 10. And he's gonna come tell us about what's going on in CPAB with his colleague, Mike Hilling, who you've seen before as well, and is from Vancouver. Jeremy came out from Toronto to see you, and maybe a couple other things as well. Of course, left of Mike is also Mike Moretto from the British Columbia Securities Commission. You've seen him many times come to our event and speak. We know him well, and he'll tell us what's going on with Anita this year, who you've also seen many times from the BCSC about what's going on. And we have a new member today, and his name is Brett. And I hope you like him. We do. We think he's a lovely person. In his first year with us, because Andy is no longer with us, because he's president of the TSX Venture. A couple things that we're putting on as a firm as well that we'd love for you to come. VRIC is happening, starting this coming up week. We're going to do a little breakfast at the Terminal City Club. All you got to do is put see that QR code there? You can scan it with your phone, and it'll give you some details there. And we also do a pretty varied representation at PDAC. We have a booth there, 346. It's over on the supplier side. We do a double booth. We bring in kegs around 3:30 or 4 p.m., a couple of snacks. So please come and say hi to us. We're going to have quite a few of us out there. Myself, Mike McLaren, Carmen, Stephen Hawkshaw, Stephen, Bahar, Sonia, Jen. So we're kind of putting some effort in this year to say hello to everybody. So please come and see us there. This event is being recorded, but we're not airing it live. There's lots of people who ask us if they're going to be able to see it later, and you will. So the recording and the slides will be available next week in case it was so interesting for you that you want to watch it again, or send it to all your friends and colleagues that they could view it as well, and do that. Questions? Some of you remember that we used to have these cue cards here, and used to write little questions and hand it up to us, and we used to answer them and pass them around. And so we have accepted technology, and so you can scan that, and you can write down your question as you hear people speak, should you like. And we will give you a PD certificate when you leave here today. If you leave early, then we may not give it to you. It also depends how early you will leave. If it's a number of minutes, that's reasonable. But if you're going to leave as soon as I finish speaking, you do not get a certificate. Okay, that's that. So we'll go on. Each speaker will come up, talk about what's going on in the organization. Then we're going to do the Q&A session. We'll have a little bit of interaction, and hope you find the content very useful. So first up, from CPAB, Jeremy, are you going first?
Yeah.
Jeremy is the Vice President of External Outreach and the Chief Risk Officer, so a very important role at CPAB, and he's going to talk about what's going on in your organization. Jeremy?
Thanks, Jerez, and really pleased to be here today. I think this is a great session for us to kick off the year and just give a sense around some of the things that, as we look backwards, around some of the things that we've been focused on the last year and some of the key areas that we're focused on going forward as we look into 2026. And also joined today, as Jerez had said, with Mike Killing, who's our inspection leader for BC here today. So just a quick overview from a CPAB perspective. Some of you may be familiar with us, some may not be familiar with us. Our role is we're the national audit regulator for audit firms that audit public companies. And so for any audit firms that audit public companies in Canada, register with us. Part of the audit firm outreach that we do, or oversight that we do a couple of different things in our outreach. We do reviews of the system quality management of the audit firms to make sure that they're taking all the key steps within their processes to have consistent levels of audit quality across their entire practice. And then we do review a sample of inspection files, and some of you who may be associated with reporting issuers may have seen some of the reports that we do and the work that we've done as far as reviews of audit files. We also, as part of our work, we have the area that I lead up, our external outreach, which includes our stakeholder engagement, so our outreach to audit committees, to CFOs. If we haven't talked to you, always interested in reaching out to myself. Alex Chung, who also leads our outreach here in BC, is here too as well, so feel free to reach out to him. Always looking for opportunities for us to present at different conferences, at different opportunities to meet with you one-on-one to talk about key issues that are top of your mind as well. Also publish some thought leadership around ongoing emerging issues and just trying to keep on top of issues that impact audit quality. And then we also get involved at international level through International Forum of Independent Audit Regulators, giving our perspectives and having Canada have a perspective at the international level as well. So thought I'd just spend a couple of minutes on talking about some of the things that we've been focused on as we look backwards from 2025, and then I'll talk in a minute about some of the things that we're focused on as we look into 2026. So first one, impact of technology and AI. That is kind of more and more a pervasive issue that every time we open the newspaper or talk to anyone, AI and where AI is going is really an important area. And I think that covers a bunch of different topics. It could be how you may be using it as a company, how's that being built into your financial reporting process and what impact that has on the quality of your controls, internal controls, how that impacts the audit, how the auditor is responding to that. Then also how auditors themselves are changing their processes and adopting technology to make themselves more efficient, effective, thinking about how that impacts the quality of the audit, efficiency of the audit. So a lot of conversations we have with directors, CFOs around how that's changing, where that's moving, and also talking to the audit firms around where they're taking technology going forward as well, and trying to make sure we have an understanding of how that's going to impact the quality of the audit. Second area was supporting audit quality at smaller audit firms. that's a really important initiative to us, especially many of you are dealing with companies within the Venture Exchange. There are so many smaller audit firms that are located within Canada that audit reporting issuers. One of the areas that as we've looked at results over the last couple of years, seeing as that's an area that we can play a bigger role as far as helping to support smaller audit firms. And we look at smaller audit firms as firms that aren't part of a larger global network that may have the ability to get guidance and support and more critical mass to be able to understand the issues and develop guidance, and think that there's a role that we can play as far as helping to share some of the findings, helping share some practical guidance and information that really helps to support audit firms. When we look at the marketplace, I think the last time we had looked, around 40% of Canadian reporting issuers are audited by smaller audit firms, so firms that are not part of larger global networks. And that's a pretty significant number of companies, so really important for that to continue as far as the support we do around that. System quality management, really important as we look at the work that's being done and starting to see much more of a correlation where firms have a strong system of quality management and controls within the firm to allocate resources to assess risk and be able to respond quickly as changes are happening within their client base. The better controls that audit firms have, the better audit quality that we've seen going forward. And so continue to review the system quality management of the firms, provide thoughts and input around how firms can be increasing their focus, changing how they implement controls within their own practices themselves. Fraud is kind of an overriding issue that we have a really important focus from kind of across the whole industry as far as whether you're a CFO or a controller within a company. Think about what controls you have as a company to identify and prevent fraud, what the role the auditor is playing, what role regulators are playing, and so that's an area that we continue to build the focus, having conversations, thinking about how we all collectively can do better as we look at changes in technology, changes in other areas that increase the ability or opportunities to have fraud occurring. And the last one, which is one that if I look backward and also look forward in a minute, is thinking about what we disclose ourselves from a CPAB perspective. So we have historically provided public reports that summarize all of the results of the work that we've done. The last couple of years, we've had a lot of input from directors, from investors and others that are saying we should provide more information. And so pleased that as we look in 2025, we did get the final approvals for changes to our rules and legislation that will allow us to increase the amount of information we disclose publicly. And so if we look at information that audit committees or directors are receiving, we did make a change last year that provides that if we have a file that we've selected for inspection, the audit committee the audit firm is required to provide any findings that come out of that review to the audit committee. And so you should expect a conversation with your auditor if the file has been selected and something in writing from CPAB that shows the findings that have come up. So that's something that's changed, and then I'll talk in a minute about other changes that are coming as we look into 2026. So the last area I was going to cover was just where we're looking forward, and there's some that are overlapping what we did in 2025, but some new ones. Hard to avoid the first one as far as the economic, geopolitical environment, so many changes that are happening. Every time you watch the news, there's something new that's happening in a different country, and I think certainly being aware of the impact that's having from a financial reporting perspective and estimates and all of the key judgments and disclosures that are required in the financial statements. So that's a key area of focus probably for us, and I'm sure all of you, as far as what impact that's going to have going forward. Technology, don't have to say a lot more about that one, but just continuing to look at the impact and that technology is having on financial reporting and on the work that's being done by auditors. Ethics, culture, and governance is also an area that we continue to focus on. I think that's a really important area as we look at the important role that auditors play in building trust in the marketplace. And since trust is so important, it's really important that auditors are focused on the public interest responsibility they have to have the best, highest level of ethics in all the key decisions and approaches they take. We've seen some instances in Canada and internationally where there have been ethical breakdowns and things that should be done better. And so trying to continue to focus on sharing best practices, sharing some of our findings around ethical issues, and trying to make sure that the auditors are setting a tone as far as the importance of ethics within their firm and the key decisions that are being made. Smaller audit firm quality still continues to be a focus. And I think the last one, which is following on from our disclosures, is now that we've put in place all of the key changes to our disclosures, you will see something different from us in 2026, which is we now have the ability to publish individual audit firm reports. So as we finish the 2025 inspections, which are coming to a close right now, we're going to start reporting publicly on the results of each firm that we inspect. And so starting probably in March, you'll start seeing the first set of reports that we publish that'll give you a sense of the number of files that we've looked at within an individual audit firm, the number of files that had significant findings, and a bit of a summary of some of the key findings that we had seen in the files. And so that's something that is new for us and provides a bit more of a ability for CFOs, for audit committees to have a conversation with the audit firm around things that they're doing to focus on key areas that are coming up in the file inspections. So those are the key areas, so feel free to look for any questions that you may have, and as Erez said, putting that into your app or asking questions a little bit later on, and turn it over to Mike to talk about some of the recent findings.
Okay, thanks, Jeremy. So before I go into further details on inspection results, I just want to highlight our approach to file selections and significant findings. So when selecting files to inspect, we use what we call a risk-based approach. So as part of this, we look for indicators of heightened risk. And there's several factors that we look at, such as unusual accounting, financial liquidity challenges, and changes in auditors close to year end. And as the files that we do inspect tend to be higher risk, our results are not a representative sample of all Canadian reporting issuers. And within the audits that we do inspect, we also focus on the riskier areas within the audit. And when the auditors don't do enough work as required by the auditing standards, we do issue a significant finding, which the auditor is required to remediate. So in terms of inspection results, last year we saw a significant decrease in the number of significant inspection findings as it relates to the audits of venture issuers. And we're still finalizing our inspection results for this year, but it seems like that trend has continued. And while results by firm are mixed, we are seeing that decrease in significant findings as it relates to the audit of venture issuers. In the third week of October, we issued our interim inspection report, which summarized our key themes and findings from inspections we performed to date. I'll just highlight some of the key themes that you'll see in that interim report. The first is around technology used in audits. So in our inspections, we are starting to see the use of more sophisticated technology-assisted audit tools. And some of the findings that we've seen to date as it relates to the use of these tools relate to, one, the auditor's evaluation of the completeness and accuracy of the data, i.e. the inputs that are used in these tools. So that's one finding that we've had. Another finding that we've had as it relates to the use of these technology tools is evaluating whether the settings and criteria that these tools are using are really fit for purpose. So for example, these tools may identify low risk or high risk transactions, and depending on the output of that tool, if it's low risk or high risk, it'll be subject to varying degrees of audit procedures. Another theme relates to findings related to the evaluation of management's accounting policies, considering potential for management bias. So as it relates to this, the accounting matters that we've observed that have resulted in findings, they have varied considerably. So there's not one particular area where we're seeing accounting errors and restatements, but we have noticed some commonalities in the circumstances that resulted in restatements. And one of those commonalities is actually no evidence that the auditor has obtained and evaluated management's accounting policies for complex areas. The third theme is around identifying and responding to the risk of fraud, such as considering whistleblower reports in designing audit procedures and concerns related to asset or business combinations with impairment recorded shortly following acquisition. So I would encourage you to read the CSA staff notice issued in July 2025 around regulatory concerns with certain asset or business combinations. That's staff notice 51-366. And then following that CSA staff notice, CPAB issued a risk alert in October 2025, which highlights considerations for auditors evaluating acquisitions of a business or asset that appear to have little or no operating history or actual value, and that were then fully impaired shortly after acquisition. So I'll now just kind of touch on findings that we're seeing just at a high level from an industry perspective. From a mining perspective, we have seen a relatively low number of significant findings in this industry. And the findings that we have identified generally relate to the findings that I just spoke to. As it relates to cannabis and crypto, historically these were industries where we saw a relatively high amount of significant inspection findings, but we have seen also a reduction in significant findings in these industries as well. And two potential causes for that. So one, auditors are getting more experience auditing in these industries, which has helped reduce the number of significant inspection findings. We've also observed auditors engaging more external experts, particularly in the audit of crypto. So we are in the process, as I mentioned, of finalizing our inspection results for this year, and when we expect to release our 2025 annual report in March of this year. So on the slide, we've just outlined some additional resources that you can consider reviewing. So this includes our resource center. So there you'll find various publications and the inspection reports that we've published. There's the CPAB Express, which is a newsletter which covers upcoming events, publications, current and emerging issues, and also international regulatory developments. There's also the CPAB Bulletin. So this provides updates on enforcement or other regulatory actions. And if you'd like to contact us after this event, you can feel free to email us at stakeholderengagement@cpab.ca. And that's it, I think. Russ? Yeah.
Okay, great. Thank you, Jeremy and Mike. Good to see inspection findings are going down. Hopefully that stays like that, right? Okay, great. I see Mike hovering around me, so I think he's up. What do you guys think? Mike Moretto, I don't even think he needs an introduction. You've been with us since day one. Great to see you, Mike. Thanks as always. Here you go.
Perfect. Thank you, Erez, and thanks to the CPAB guys for their presentation. Let me get organized here. I said to the other panelists, I'm going to get up there and I'm going to try to put my notes on, and I'm going to move the computer, so something's going to fall here. I think Matt's going to come running down here and going, no, don't do that. So anyway, first I wanted to thank Davidson for the opportunity to present and for all of you showing up. It's always good on the outreach side to get our message across, but just to be present in the marketplace, knowing that you can, who the regulators are, and we're available, good or bad, call us up. I don't often provide a disclaimer. I actually had to write it down today. But today's topics may draw out a little more of my personal views, so you're forewarned. I don't really know how to do a formal disclaimer. I think it usually goes along like, these are not the thoughts of anyone, and they can't be attributed to anyone. So I always think when you can't say these aren't the thoughts of the organization, it's like, well, whose are they? Like, they must be informed somewhere along the way. Anita and I will try to cover a fair number of topics, some in detail, and some will be brief, but we did try to put in a little more information on the slide side, so at least you have some takeaways. But that's also a good thing, that when you start to see the slides, you're like, oh my God, he's not going to go through all of those, is he? So that's basically what we're going to cover today, beginning with semi-annual reporting, a little bit on the life, some accounting stuff on IFRS 18 non-GAAP, and then just where we are and where we're going at the commission. So, starting off with semi-annual reporting, really trying to make a literary connection here for those who have kids or can remember Dr. Seuss, Green Eggs and Ham. The story about a main character refusing to try green eggs and ham, and the book's written in such a way that the character, he or she, regales all the ways they will not try green eggs and ham, and at the end they try it and they actually like it. So I thought that was kind of how I feel about semi-annual reporting. Is we've tried it a lot of times, and everyone has said, no, I don't want that. I will leave you an interesting fact about this book. When I was kind of looking for the linkage, the book was written with only 50 words, which when you read the book over again, you're going to go, wow, like that. It's amazing that he did that. I guess his publisher bet him $50 that he couldn't write a book with 50 words or less. And so this book came out immediately following Cat in the Hat. So in keeping with Dr. Seuss, I'll try with the why now, why how who, and how you. So why now? This is kind of gets a little personal for me. I've tried this, I've been involved with this kind of idea going back to 2010. We've tried in the past without success, but we feel it's worthwhile to keep trying. We think that this time, the environment, being political, economic, may be different. And we think there's certainly a call for burden reduction, as well as other ideas to create economic competitiveness. So the hope here is the time is right. Historically, the way we've done it, always asking it in a conceptual question. What do you think about this in concept? And we've always found the feedback to be mixed. So we're hopeful we may benefit from a change in approach. I kind of view it internally as like flipping the script, showing our vision and then refining it over time. So that gets us to the why, how. What we're doing this time is tackling the topic with a different approach through the implementation of a blanket order, and then there's a little twist that it has to be a local rule in Ontario. But what the blanket order does is it allows us to put the concept out in an exemption basis, and what it kind of the mechanics behind the process. We don't have to write the full rule. We can put it out in concept and say, hey, what does the street see? What do they like? What do they dislike? And so we're really trying it in a different light. And the hope here is that will help us refine things down the road to what I would think is a better rule, a clearer rule, and a bit more tested. So it'll give issuers the opportunity to look at it, see what others are doing, and adjust accordingly. I will say, I won't really touch on the local rule in Ontario, although I do have a former colleague who's from Toronto, so he flew out just to see me, I think. But the Ontario has just a quirk in their securities legislation that they can't put blanket orders out without having them recur every 18 months. So their thought is we'll do a local rule, so it's a bit more permanent in view. So we've been explicit in the notice that we intend to engage in broader rulemaking project. it's coming out as a pilot, and I think we've got a lot of feedback that said, oh, if it's a pilot, maybe are you guys going to pull it back? And the intention from my perspective is no. I think what we're going to do is we're going to learn from it, we're going to build on it, maybe we'll expand it, who knows. How-who. In terms of the how-who, it's pretty straightforward. Voluntary, limited to venture issuers listed on the TSXV and CSE, must have annual revenue of less than $10 million, and must be current with their continuous disclosure record. Kind of wanted to highlight the less than 10 million. It seems we just had to put something out there, and for lack of a better descriptor, there was some debate across the country, so we decided to put a revenue limit. But I wanted to highlight from a BC issuer perspective that we expect that when we looked at it, greater than 94% of our venture issuer base listed on TSXV and CSE will be eligible to use semi-annual reporting. So how you? What are the key elements? Exempted from Q1, Q3 financial statements, no succinct 3-month statement of comprehensive income needed in Q2s. All those also exempts issuers from some of the MD&A form requirements in Q2. And I've been, as a res, I don't know, you gotta stop mentioning that he's been here forever. It's like, maybe he's been here a while. I don't know. There's ageism, but this actually kind of takes me back to about 10 years ago, and I look at this and I start to think about streamlining. So, if an issuer went into voluntary semi-annual reporting, and then they could also think about MD&A provisions that are also in there, such as a summary of quarterly highlights. And that hasn't been much of an uptake on that, but that's much more narrative view of their company in the MD&A. So I think if issuers were to think about streamlining, there's some great opportunities out there. So we'll throw that out there. Next steps. As I say, we're trying something a little different, and with the blanket order side, we actually put the blanket order out for comment, and that's something we've only done once historically in thinking about blanket orders. The logic, though, was Ontario had to put their local rule out for comment, so why not put our blanket order out for comment? It allowed us to see kind of fatal flaws, and also ask ahead for areas for us to think about in considering our next steps in the next phase, which I talked about in the codification side of it. What did we hear? General support again, with some trepidation. So, again, it was a majority were in favor, but there was always comments about, okay, now the comments come in to be much more specific. Oh, what about eligibility? Should you think about this, this, this? Or the other one is a perceived gap in information as it relates to Q1 and Q3. So certainly we're going to take that away as we formulate the next phase. And so, as I said, the future comment focus were on bucketed themes, eligibility criteria, alternative disclosure for Q1 and Q3, and other much more specific areas like the interplay of RTOs and transactions, and as well some commentary about how it can be used in the offering sense as well. So stay tuned on that. I'm somewhat excited because I do think it's time for Canada to think about semi-annual reporting, and I think if we get there on a voluntary start, that it could be the wedge into thinking about the difference, a way we're reporting to the stakeholders. All right, switching gears. Also wanted to provide a brief update on the listed issuer financing exemption, or the life exemption. I think I spoke at length at last year's session about life and giving the background. So fast forward a year, we made some changes earlier in the year, and the growth has just been exponential, as we'll see in a couple of slides. So this is just a recap of what life is and how we got here. The benefit of the exemption is that the key benefit is that issuers can raise capital using a prospectus exemption, allowing the issuance of freely tradable shares. In terms of the framework, general conditions, issuer must be reporting for 12 months, be listed on Canadian exchange, and had filed all timely and periodic disclosure documents. Offering has restrictions around offering limits, dilution limits, and use of proceeds. So in May of 2025, we expanded the exemption based on kind of what we had learned since its implementation in November of 2022, and based on the feedback and the reaction in the marketplace. This is where I'm really not going to dive into the details too much, but I'm giving 2 slides that give a bit of the background on the changes. But really the highlight of the change is we increased the offering limits from which were previously greater of 5 million and 10% of market cap up with a rolling 12-month limit of $10 million to the greater of 25 million, 20%, and a rolling limit of 50 million. There's a couple of other changes around dilution and control that I'll just leave you with, but really, if I had to highlight, it's the offering limits changed greatly. So what did that do? Catch up here, and when I read this slide this morning, I thought, oh boy, this is the accountant in me being the accountant. It's nothing but numbers and graphs, and it's very busy. But the result of the change in a picture is pretty stark. We've seen exponential growth since the change to the exemption in May of 2025. I'll qualify that the growth appears to be a combination of many things. I don't think we can fully take credit for everything, but it includes, market factors, the strength of the life offering, and what we've seen in BC is the mining industry is in a good position right now and has been taking great use of the life exemption. So, when we think about it, the percentage of issuers in the mining space using life has kind of jumped to about 85% of all monies raised under life. From a BC perspective, we're accounting for about 50% of the monies raised under life. So we're pretty happy about it, but we're not resting on our laurels. Pardon me. Our next steps in the area are to codify these changes that we put out in May of 2025, again under a blanket order, and then to address some other enhancements based on comments we've been getting over time, and trying to provide guidance where there has been, what I'll say, thematic questions that have been similar. So we're always trying to improve the guidance that we're providing around the life exemption. But certainly a very a promising exemption that has really taken hold in Canada, and I think we're excited to see where it'll go. So with that, I'm going to turn it over to Anita, who's going to cover a few of the other topics, and will certainly be available for any Q&A at the end. So thank you for your time.
Thank you, Mike. So this is the first regulatory update I'm giving it in this new year. So ahead of that, I did a little bit of internet sleuthing on some of the predictions ahead. CBC.ca tells me 2026 is going to be the year of amazing transformation to the way we think. People.com tells me that this year will bring a series of transitions that will reshape everything. So I think these predictions are based on astrology, but I like to think they're following accounting standard setting in Canada as well as internationally, because finally, IFRS 18, the new standard on presentation and disclosure of financial statements, is here-ish. It's effective Jan 1st, 2027, with retrospective application required. So that's why I say this is the year of transformation. You will need to have those 2026 statements available under the new format as comparatives for 2020 in the next year. As well, certain reconciliations will be required in your interims and annuals of next year as well. And I liken the project to kind of a road upgrade project. There's not a fundamental change in how you get from A to B. The income statement is still going to tell you how the company did for that period. But there's going to be clearer signage, there's going to be more rules so that it's more comparable from entity to entity. And this is in response to users who've asked for more relevant financial statements. The next slides, I'll cover some key impacts, but I do want to highlight key impact to your financial statements. But there are implementation considerations as well outside the financial statements that we'll briefly speak to. Your system, there might be system changes needed as you map line items to different categories and totals on the income statement. Your legal and procurement team may need to be involved if you have contracts that have terms that are tied to financial performance. Those might change, so may need to be updated. Your IR teams will probably need to be called upon to review all public communications outside the financial statements to review whether they're non-GAAP financial measures. A subset of those will now have to be brought into the financial statements. So there is going to be a lot of spade work in 2026 as we move toward the new standard. Of course, the accountants will also have to do a lot of work, not just on the financial statement formatting, but a lot of the judgments that go into confirming what your income statement will look like. And I think as you walk through, you might think, there's not really a significant change based on my operations. I think where the work will be done is in the judgments to document why that's the case. And of course, under IS 8, as well as our MD&A rule, with a change in accounting policy, you do need to disclose the anticipated effect on your financial statements. So as we move closer to implementation date, we'll expect more detail as we get closer. So some of the key impacts to, as a result of IFRS 18, companies will now have to classify their income and expense items into 3 categories: operating, investing, and financing. Fairly, I think, intuitive. Operating category includes items relating to your main business activity. It's also the default for any items that don't meet the definition of an investing or finance activity. Companies will know how to present defined subtotals and totals. As well, companies can still present additional subtotals if they present a useful, structured summary of the operations. It's very similar to what exists now, except the rationale is slightly different. Currently, additional subtotals are required if they're relevant to an understanding of the financial performance. And that changes now to a useful, structured summary. So that's one of the judgments that the companies will have to document. Another change, reporting issuers will now have to present operating expenses either by nature, by function, or mix, whichever method, again, we have this concept again, whichever presents the most useful structured summary. It's unchanged. The certain expenses by nature do have to be disclosed in their totality, so depreciation, amortization, employee benefits, impairment, and write-downs of inventory and reversals. And again, most venture issuers today, most of our issuers review do some sort of mixed method, which again, it will continue to be allowed, but there's going to be work involved to document why that presents the most useful structured summary of the company's operations. There's also some consequential amendments to other IFRS accounting standards to mirror the concepts in IFRS 18. Of course, in the interim financial statements, there's amendments to introduce the same concepts of aggregation and disaggregation going back, companies do have to, there's going to be enhanced guidance on grouping of information, so that's the aggregation and disaggregation of information. These will have to be presented in whichever way, another impact, this will have to be labeled in a way that faithfully represents what the characteristics of that line item is. And with enhanced guidance, it's going to be more difficult for companies to use a descriptor called other. You still can. I think, again, this is the idea that there's going to be more documentation involved in terms of why you couldn't come up with a more descriptive line item. In addition to the aggregation and the additional subtotals and categories, these are the consequential amendments I was starting to speak to. IS 34 has updates, so you'll have to start applying these concepts in your interim financials. There's some updates to the cash flow standard. The new subtotal operating profit or loss is your starting point in your indirect cash flow statement. As well, there's no option to classify dividends or interest as operating cash flow, so that must be either financing or investing. Earnings per share, one of the things that results from IFRS 18 is the concept of management-defined performance measures. So IS 33 now allows you to present adjusted earnings per share based on adjusted totals in the notes of the financial statements. Excuse me. One other change that I don't expect to have a significant difference is that goodwill must be presented as a separate line item on your balance sheet. Most issuers that we review already do so in any case. So a very new requirement under IFRS 18 is the concept of management-defined performance measures. The goal of this requirement is to enhance the relevance as well as the connectivity of information inside and outside of the financial statements. Management-defined performance measure is a subtotal of both income and expenses that an entity uses in public communications outside the financial statements to communicate an aspect of financial performance of the entity as a whole. They're not the explicit totals and measures that are listed in the IFRS accounting standards. So in order for a measure to be a management-defined performance measure, it first must be a non-GAAP financial measure. So this goes back to companies having to review their public disclosures to get the inventory of measures that may meet the definition. Because once a measure is an MPM, it must be disclosed in the financial statements. In a single note to the financials, and under certain criteria, MPMs may be presented on the face of the financial statements. MPMs, once they're disclosed in the financial statements, do require certain accompanying disclosures. You must have a caveat language that states that it's not comparable to other entities that might have a similar name, an explanation of why the MPMs provide useful information. As well, I don't have this on the slides, but obviously there's disclosure about how the measure is calculated and a requirement to reconcile the MPM to a required subtotal or total on the face of the financial statements. So very similar, for those of you familiar with securities law, to how the disclosure requirements we have in our non-GAAP rule. Speaking of our non-GAAP rule, not similar to semi-annual reporting, but non-GAAP rule, we actually only implemented a rule in 2021, although we've had staff notice guidance out since 2003. So it was another area where, despite our best efforts to provide guidance to the marketplace on the accompanying disclosures that need to accompany these measures so that they're not misleading, the market wasn't quite getting it right, and this was a common finding that we would highlight in our CD review notices. So we proposed a rule in 2021. Unfortunately, the timing meant that when IFRS 18 comes out, there's a slight disconnect in terms of the definition that we have on non-GAAP financial measures. Right now, that definition includes that it's not disclosed in the financial statements. So in order to ensure that non-GAAP financial measures continue to be captured if an entity discloses it outside the financial statements, we're proposing amendments to our Rule 52.112. The comment period is still open, so if you have comments on that, I encourage you to send those our way. Really, it's to update the definition of non-GAAP, but we also allow cross-referencing to disclosure in the financial statements. As I previously noted, a lot of the disclosure requirements are consistent with what we have already. So in order to avoid duplication, we're allowing that cross-referencing. IFRS 18 also allows for additional subtotals, so long as they're not more prominently presented as compared to required subtotals. So we required that prominence requirement for additional subtotals that are presented outside the financial statements. We are working towards having this finalized before the implementation date of IFRS 18, so stay tuned for that. So switching gears one more time to areas of regulatory focus if commission staff review your company's CD. What are some of the topics that we've covered? For detailed summary, I'd refer you to the two notices that I have listed here. The second one, 51365, we publish a biannual publication of activity of CD review notices across the Canadian Securities Administrators. The last one, this publication for years ending 2024 and 2023 is still the most updated one and continues to be relevant, so I point you in that direction. Mike Hilling did refer to our notice 51366, highlighting concerns with certain acquisitions that we're seeing, especially in the venture market. It's about a particular fact pattern where issuers enter into an acquisition where they issue a very significant number of shares to acquire an asset or business with little or no apparent value or operating history at what appears to be significantly increased prices. While most of our notice discusses concerns we have from a market integrity perspective, it also touches on accounting and MD&A disclosure considerations as well. For example, the issuance of a significant number of shares for asset or business that's shortly impaired raises questions about the economic substance of the transaction, as well as whether the appropriate accounting was applied, especially in the areas around business combinations, impairment, intangible assets, and valuation. And these were the topics that we also touch upon in our CD review notice 51365. So both of these publications continue to be good sources for you as you finalize your year-end reporting. One other topic, another common area that we raise comments on is promotional disclosure, overly promotional disclosure. We have seen promotional campaigns where issuers provide unbalanced or unsubstantiated material claims about the business, and the corresponding opportunity to profit from the company's shares with the specific purpose to artificially inflate the share prices of that company. Recently, we've seen promotional activities focus on AI washing, what we're calling AI washing, where entities try to capitalize on the market's interest in all things AI, and they make exaggerated claims about the use of AI systems in their products or services. Greenwashing, where companies make potentially misleading, unsubstantiated, or otherwise incomplete claims about companies' operations or the sustainability of the product or service being offered, creating a false impression. Another area of overly promotional disclosure is around non-GAAP financial measures. I've started calling this gap washing to keep on the washing theme. Without the appropriate accompanying disclosures, disclosure of non-GAAP can be misleading because they're not based on the framework that's required under our Canadian securities law. Generally, they're always positive and upward adjusted, so we do require certain reconciliation. So I would say beware of your disclosure laundering as you finalize your year-end reporting. A few publications we want to highlight. Late last year, final amendments to our expedited base shelf prospectus regime were published. This allows well-known seasoned issuers in Canada with a strong market following and a complete CD record to access capital in Canada by allowing them to file a final base shelf and prospectus and have that deemed to be receipted without first filing a prelim and undergoing regulatory review. Notably, the effectiveness period for base shelves is now 37 months. It was previously 25 months. And in April 2025, I think we've alluded to, based on the environment at the time, competitiveness of the capital markets is a priority for the Canadian Securities Administrators. We published blanket orders that provided broad relief to entities that meet the criteria in those blanket orders relating to prospectus and capital raising. Included in those blanket orders was relief for financial statements for the third year back and certain IPO prospectuses. There was also a new capital raising exemption for new reporting issuers within 12 months of their IPO, essentially allowing them to rely on their IPO prospectus rather than create a new one. What else is on the horizon as we work towards the end of 2020? I think we just started, but as we work for the rest of the year, we've the comment period relating to the modernization of mineral project disclosure just closed, and our colleagues are reviewing the 78 comment letters that were received. As we move towards the end of 2026 and 2027, next steps are to revise the proposed revisions as necessary, get legal and legislative approval and internal approvals across all the jurisdictions before finalizing a new rule. There's 2 continuous disclosure filing projects, access instead of delivery. Proposals relating to this were initially published in, I want to say October, November 2024. It's a framework to allow issuers to access financial statements, MD&A, electronically through CDR Plus. So that work continues as part of the streamlining of CD and reducing regulatory burden for issuers. There's also the continuous disclosure project, which was part of the reducing regulatory burden project. I think 6 to 8 years ago, we had 6 streams, and this was one of them, where we would combine the financial statements, MD&A, and if applicable, the AIF into one filing. So work on that has picked up again, but stay tuned. If there's a new framework, sufficient notice will be provided to the marketplace as we work through that policy. For those interested, the Canadian Securities Administrators did publish our most recent business plan this last summer for 2025 to 2028. Notable initiatives include supporting growth issuers. So we've committed to doing research and considering international development or how international markets treat their smaller issuers, and benchmarking that against Canadian requirements, and considering whether regulatory changes are appropriate for our marketplace. There's also initiatives relating to reviewing private placement hold periods, as well as reviewing the normal course issue bid regime. So with that, in summary, I think 2026 will be, if not transformation, it'll be a year of transition as you work towards a new look income statement, and as we introduce semi-annual reporting and you navigate new financial reporting processes. So we're also looking to consider other changes that could make our regime more efficient. So with that, my time is up, but Mike and I are happy to answer questions at the end, but also by email, so reach out to us. Thank you.
Thank you very much, Anita. Oh, Brett's already hovering on me. I can't crack a joke for 30 seconds. I couldn't help but dwell a bit about what you said. You know, in Lunar New Year, it's also the year of the horse, right? And after the snake, you scrape. So, and then it's 2026, you know what I mean? Michael, I keep pointing at you because you're just at my, but COVID started like almost 7 years ago, right? So isn't every transformational period 7 years? Or, anyways, next year. Well, it's the beginning, and it's not exact science probably, right? But there's a lot going on this year, right, compared to many other years. So we'll talk a little bit about that some more. And joining us for our first time is Brett. Many of you know him well. You know, he's a senior listing manager at TSX Venture, a wonderful, calm person who's very insightful as well. We miss Andy, but we are equally happy to have you as well, Brett, from the TSX Venture. Brett.
Awesome. Thanks very much, Russ. Let me just get organized here. All right. I can take that down, I think. All right. So great to be here today with all of you. And so today we have both a market update on tap as well as a fairly significant TSX Venture policy update for you. So let me get into the market update first. And so as you can see on that slide there, TSX and TSXV remain one of the top hubs globally for equity capital raised. So over the last 5 years, combined on the TSX and TSX Venture, our issuers have raised plus minus $160 billion, which is pretty good, I think. Our exchanges, they continue to reflect a fairly kind of robust, diverse market, I think it's fair to say. As you can observe from the chart here, just a couple of points worth mentioning on this chart. The the mining share has gone up slightly from last year, and that's owing largely to the strong mining sector performance in 2025, which was very strong, and kind of gold soaring to new heights. Financial services, as you can see there, it continues to represent a kind of good chunk of our overall market. And then if you look there as well, you can see 6.4 trillion. So that's the total market cap of all TSX and TSX venture companies in total, which is pretty good, although it's pretty sobering, though, to consider that the market cap for NVIDIA, listed on the NASDAQ, is itself $6.2 trillion in Canadian dollar terms. So
Higher.
we're higher. We just beat them, right? So hopefully we can keep that going next year. So value traded is up significantly over the last 10 years, as you can kind of see. So that's value of kind of shares traded on our exchanges, both TSX and TSX Venture. If we compare it to 2016, the value of shares traded on the TSX and TSXV in 2025 is up across all the sectors. So moving along here, so this slide here shows TSX Venture specific equity capital raised on a kind of year-by-year basis over the last 15 years. In 2025, the figure was $10.1 billion, which is tied for the second best financial year in the last 15 years. So it was only bested by 2021, which had $11 billion there. It's worth noting that for 2025, 2/3 of that $10.1 billion, it was raised in the second half of the year. So $6.7 billion was raised July to December, meaning that like the recent trend lines are pretty good, in other words. Not quite as positive is the equivalent financing stats on the TSX. These are kind of down significantly from the 2010s overall, with a slight uptick in 2025 from the most recent years. You can see 23.3 billion there in 2025 as compared to 16.2 billion in 2024. Okay, on the new listing front, so this is like new TSXV listings on an annual basis. So what I'd say here is that the news is not as good. It's on the financing front. New listings kind of continue to remain a bit of a challenge. That's not really a Canadian-specific issue. I would say it's more of a kind of global phenomena. There's just more private equity out there, more private capital available generally, and issuers are just kind of remaining private longer. But yeah, you can see from, say, 2001, we had nearly 2,700 issuers on the TSX Venture Exchange, which compares to just north of 1,500 TSX Venture issuers at the end of December 2025. So that's quite a significant drop. Context is always important, though, too. Okay, did I mess up my slides here? Yep, okay. So, yeah, what I would say is that, like, on the flip side of the fact that we have like a lot less listings, is that the average market cap of our issuers is kind of way up. So for example, the kind of average market cap even just 2 years ago of the TSX Venture listed issuers was $42 million each, and that's kind of 92 million as of the end of December 2025. So overall, the average market cap has definitely kind of increased over the years. So on the The next slide here is graduates to TSX. So I'll have to go back here. My notes, so graduates to the TSX from the TSXV has been pretty stable overall. We had 11 graduates in 2025. We consider these all very big wins from a TMX group perspective. Every graduate from the TSXV to the TSX kind of validates our kind of two-tier ecosystem. Okay, so we touched on that one. So that's the average market cap there. You can see it's really grown since, especially 2002, 2003. I think it's fair to say that the overall quality of our issuers has kind of increased quite substantially. Okay, so moving on here. So let's go to section 2. So this is the policy 5.4 update. So we at the TSXV, we undertook a fairly sizable, significant overhaul of our policy 5.4 in 2025. Policy 5.4 deals with capital structure, escrow, and resale restrictions. So I will give a brief overview of some of the major changes associated with policy 5.4 without going into all the details. The official slide deck for these changes is 50 slides, and so I've spared us all by kind of whittling that down quite a lot. So this really and truly is just like a Coles Notes version of the changes to policy 5.4. So to that end, we need a second disclaimer. So before we get into the changes to policy 5.4, I do need to say that this presentation is not a substitute for exchange policy or the new form of escrow agreement. As always, the written word of policy does prevail. Okay, so there's your second disclaimer for the day. Okay, so capital structure for new listings. So what do we mean by new listings? Well, these are reverse takeovers, change of businesses, qualifying transactions, direct listings, IPO. Policy 5.4, it helps the TSXV ensure that every new listing applicant has an acceptable capital structure. The idea of assessing for acceptable capital structure is not something new in policy 5.4. What has changed, though, is that we've modified some of the tests by which applicants may demonstrate that they indeed have an acceptable capital structure. So what are these tests? So let's look at the revised test under policy 5.4. The first is a 10% contemporaneous financing, it's a bit of a mouthful, or a financing of not less than $5 million. So a 10% financing or a financing of not less than $5 million. So a majority arm's length $5 million financing, that's kind of self-explanatory. But what do we mean exactly by a 10% financing? Well, what we are looking for here is a financing that represents at least 10% of the shares being issued as part of the go public process. So just to give like a very, very crude example, let's say you have a TSX Venture shell company, perhaps listed on NEX, and they have 10 million shares. Let's say they're undertaking a reverse takeover, acquiring a property, issuing 80 million shares. Well, to have a 10% financing, you would need to do a financing of 10 million shares at an acceptable financing price. So 10 over 100, 10%. Previously, under the old policy, the requirement was a 20% majority arm's length financing. And we heard feedback over the year that issuers just kind of were not always, they didn't always like that 20% requirement, let's just say it like that. And so they would say things like, why am I being penalized for raising funds at a higher price? So if I could raise it 20 cents, but I decide to raise it 40 cents, Why am I being penalized? That's half the number of shares, right? So the modification to 10% from 20% should like address and alleviate some of these concerns that we've heard over the years. It's fair to say that the contemporaneous financing, hope that's the last time I have to say that today, or what used to be known as the concurrent financing, is the most common way that issuers demonstrate acceptable capital structure, and it's not really even close. In my experience, it can be challenging, especially for mining issuers, to establish acceptable capital structure via some of the other tests. So what are these other tests? Well, they include appraisal or valuation that supports at least 50% of the consideration. And consideration is a defined term, which just basically represents the cash paid and the value of the shares being issued for the target business or asset. Expenditures in the last 5 years that support at least 50% of the consideration. So for a mining issuer, that would be like mining property expenditures incurred in the last 5 years. For a tech issuer, that would be like bona fide R&D expenditures incurred in the last 5 years. And then we have net tangible assets of the target company representing at least 50% consideration. Operating cash flow of the target company that supports at least 50% of the consideration. Now, not many venture issuers have cash flow. Even fewer of them have like positive operating cash flow, mainly because we have so many kind of mining issuers. So this one is not one that is expected to be used all that often. And then lastly, we have securities issued by target company at acceptable prices. So the target company would have to have issued at least 50% of its shares, issued outstanding, at acceptable prices. And those prices are kind of defined in our policy. Current listing. So the issuer has been listed and trading on a recognized stock exchange for at least 12 months and has not undertaken like a reverse takeover or similar transaction during that period. And then lastly is just the IPO. If the new listing involves an IPO, then they're good to go. And just to clarify that a non-offering prospectus here would not count. Okay. So that is capital structure. So what about escrow though? What is changing, if anything, with principal escrow? So what has not changed is that under the new policy 5.4, principal escrow applies, at least as the starting point. So directors, officers, 20% shareholders in connection with new listings. As many are likely aware, the goal of escrow is to align the incentives of management with those of the issuer and the shareholders. The kind of general overarching principle of our revised policy 5.4 is to mirror national policy 46201, which is escrow for IPOs. In the case of an IPO, TSX Venture, we will defer to 46201. In the case of kind of other listings, we will generally defer to 46201 with a few caveats. So TSXV, we will impose escrow if the market cap is $100 million for a new listing, notwithstanding that 46201 would not require escrow for principals. Issuers can apply for relief here if that's the case for them though. Another deviation is that escrow does not generally apply to principals who hold less than 1% individually, and that's consistent with 46201. But the TSX Venture, we reserve the right to impose escrow in certain circumstances where the aggregate number of shares held by principals exceeds 5%. So like as an example, if you have 7 principals, they each hold 0.9999%, we reserve the right to impose escrow in such a case. And then lastly, if an issuer has traded on another exchange, we will give principals the benefit for time served with respect to escrow. And so basically what that means that we put them in the same position as if they'd listed on the TSX Venture initially. Okay, so one other big change with the new policy 5.4 is the elimination of surplus escrow regime. We previously had two escrow regimes, value and surplus. Surplus escrow, it was much more back-end weighted, so principals got like a lot more shares towards the end. They didn't obviously like that a lot sometimes. Also, with surplus escrow, if the issuer like abandoned the asset or property or business on which it listed before 3 years, they would lose all their escrow shares. So it was kind of punitive, to be honest. And so now we only have one escrow regime with a release schedule that mirrors 46201 for emerging issuers in the case of tier 2 issuers. So surplus escrow is being given the boot. And then lastly, but not leastly, seed share resale restrictions. So these are restrictions that may apply to non-principal shares. Previously, we had a bit of a complex matrix with various hold periods depending on kind of when the shares were issued and at what price. The new policy 5.4 has simplified things greatly. If seed share restrictions do apply, then it's a standard 1-year hold. Okay. So that's a wrap on policy 5.4 and the changes. Definitely hoping from a TSX Venture point of view that it's going to be helpful to our marketplace and kind of lead to a continuing bettering of our marketplace. Okay.
Thanks a lot, Brett. Well, there's lots going on. This is the Q code that you can scan if you want to ask a question. It'll pop up on the screen. It's anonymous, but we'll know who you are. So be mindful of what you ask. And now we're going to turn to the Q&A session, and we've got about 30 minutes or so to do that.
Well, what happens if, because the U.S. is talking about it too, and I don't think they've decided, right?
That's correct.
So what happens if there's a divergence there in terms of SEC issuers who file in Canada, et cetera?
Well, right now, it's funny, we had been developing it. We were 80% of the way done, and then the Monday tweet shows up. And but it didn't change our thinking. The way I think it'll play out is the SEC has been instructed to look at not essentially semi-annual reporting, but essentially he's saying, look, the quarterly reporting no longer works. So I think our regime is always been tied to theirs. I think semi-annual reporting would work for us. We'll monitor the U.S., see what they're doing. Our anticipation, though, is it should have no effect on issuers when we bring our regime in if they take more time to catch up. They're talking about also looking at SK, which is all the disclosure regime down there. So I think we're not looking to be reactive. We're just trying to plug ahead, do what we're thinking is right for our Canadian marketplace. In terms of foreign issuers using semi-annual reporting and working through the U.S. system, it works now, right? As long as you have a domestic issuer. Foreign private issuers simply file using semi-annual reporting within the U.S. But we're acutely aware of what's going on and what's being, the fast pace that's down there. And I say the fast pace in terms of the instructions on what they're being told to look at and to do. But certainly they're taking their time and following their processes. So we look forward to seeing it. And I, just again, my own view is anecdotally there had been I guess the past resistance had been partly on divergence from the U.S. So it could actually be a versions, and so we'll see.
Okay. And just kind of a couple tiny little follow-ups, but if nobody in the panel knows, that's okay, but Brett, I recall the slide we had with the top 5 markets in the world that raised capital, and Canada being one of them. What does, it's related to this, I think Australia does semi-annually, yes? What about Hong Kong, China exchanges, does anybody know? If it's quarterly or, not sure, and then
Europe is semi-annual.
Europe is semi-annually, the US and Canada currently are the same. So, assuming China and Hong Kong, you guys know? No, does anybody know here? Okay, well, we gotta get some companies listed. What's that? You think it's semi-annually as well? Okay, let's assume that for the purposes of this discussion here. So the world is sort of there. So it sounds like it's gonna happen. And then also sounds like we're gonna make our own decision rather than wait for the US to go first, is what we're hearing now too. Okay, just, Brett, maybe I could kind of come back to you a bit. With the policy that you so kindly simplified, or what have you received feedback so far? Has it simplified things? Is it helping companies?
Thanks, Raz. What I would say is it's still pretty early days. Like the policy, it just came out June 2025. So I haven't heard too much in terms of direct feedback per se. What I can say though is that like a lot of work and a lot of discussion with stakeholders and our local advisory committees in Vancouver, Calgary, Montreal, and Toronto took place. And so it really was a couple of years of kind of gathering feedback, learning where the pain points were. And so I think overall that this new policy incorporates much of what stakeholders were looking for. Two of the big wins, I would say, would be the elimination of surplus escrow regime, as I mentioned, and I think the 10% financing thresholds being reduced from 20%. It is quite a significant one in terms of the go public process. One of the things that we had heard in the past was that, hey, what if I don't want to dilute 20% off the bat, right? Like I'm a tech issuer, like I really believe in my technology, like why am I being forced to give up 20% to meet your rule, right? So I think overall it's very favorable to the markets in terms of just the flexibility it affords, and also just incentivizing founders too.
Yeah.
Right? Yeah, and so the elimination of the surplus escrow regime, like previously, if you drilled the property and you didn't have any results there, and you moved on to a different property, you would lose your escrow shares, right? Which seems a little punitive, right? So, and kind of almost ties the issuer to that specific asset. So I think now there's just kind of more flexibility, more freedom in the regime.
When is it becoming effective?
So it's been effective since June 2025. So it's been effective for like
Okay.
6-7 months now.
Okay. Yeah, that was a question that came up from someone there. Okay, let's pick on CPAB a little bit here. We've been hearing, because we're the auditing firm who get a lot of that feedback, and it's clear that audit costs have gone up from previous years. And there's lots of reasons why people think that. Well, you know, if you go to restaurants, it's a little more expensive than it used to be too. So there's a general price increases across professional service. Is that a reason? Is it because we're supposed to do more work than we used to do? Or did we just not do enough before? Are companies more complex than before? Is it just more of that? Is it remote working? Is that what's been happening? Or are we just charging more? I've got my views of the world. So anyways, what are some of the comments about audit costs that you could, as best you can, share with us?
So I'll leave the question on whether you're charging more or what kind of profits you're making as a firm. I'll leave that to you. I think we've certainly heard that, a lot of feedback around that, and I think one of the things that we had heard and seen was so much of it comes back to people. And coming out of the pandemic, I think we had seen a number of professional services, accountants are a big part of that, where there was a real challenge as far as keeping people within the profession, getting the right number of qualified auditors. So I think that led a number of firms to have to increase salaries much across the board. And so I think that led to, in some cases, fairly significant increases in fees. I think your comment around complexity is also an issue as well. I think we're finding more and more companies that are seeming not complex, but then the more you get into it, as far as the increasing use of third-party organizations to manage different parts of the business, gets more complicated from an audit perspective, and it's led to more work, and sometimes more work being done by more expensive parts of the audit, whether it's IT professionals or others that have to do that. So I think that's led to higher costs in some cases, and I certainly have heard that as an issue. I think we'd seen a bigger spike over the, kind of coming out of the pandemic. Seems like it's moderated to some extent now as far as not driving as much up as it was, but I think that's certainly an area that we've definitely seen.
Thanks for that. Just staying with CPAB, maybe I could kind of share something with you. You're overall in charge and responsible for the western region of Canada. And obviously you have a counterpart, I think, out in Ontario and maybe somewhere in the middle of the country. I don't quite recall. But what are some of the differences, if any, that you could share with us about what you see out west versus what you see out east, as best as you can share?
Well, I mean, speak about west. I mean, it's obviously the market is different out west in terms of the number of venture issuers. But having said that, I think also the challenges that auditors are facing are similar, whether it's east or west. The inspection findings that we do see, they're not really isolated to a specific region. The things that we've identified in our inspection reports, they're not specific to auditors in the west or the east. A lot of the audit issues are similar. And they often come down to what I'll call audit fundamentals. A lot of audit firms have invested quite a bit in their systems of quality management over the years. There was a new auditing standard that came out. And so a lot of the firms now have what I'll say, a good baseline structure in terms of their system of quality management. And oftentimes when there are findings, it's sometimes things that kind of slip through the cracks as opposed to more pervasive issues. I don't know if that answers the question, but in terms of the audit issues that we're seeing, it's not really isolated to east versus west.
Okay. No, thanks for answering that on the spot. I'm just going to go to a couple of QR codes things because I can see on my phone. Quick question for the BCSC. I think the semi-annual report, assuming that's going to happen, does that have to be reviewed or just management prepared?
It simply just has to be prepared. There's some mechanisms that we put in, an annex to the proposal, which will talk about the interplay with offerings. So certainly if a semi-annual report, the way it will work is you won't be able to use it for an offering, but you won't have to come out of semi-annual reporting. So you just have to supplement it if you were to do an offering. But for general day-to-day continuous disclosure, does not have to be reviewed, but does have to be accompanied by the notice of no request. So similar to today.
Yeah. But so then, like, if you're doing a prospectus or something where you consent, you still have to put the quarterly data. No, that will go away.
No, that'll go away.
Not that we need to know this by heart, but all the other jurisdictions like Australia and so forth, would they be similar where there's no review required by the auditor? Do we know if is this management prepared as far as you know, Anita?
I think Australia does have a review requirement for the semi-annual, but I'm going to disclaim that. I'm pretty sure that was the case based on some reading we did pre-year end, so that's slightly different, but that's the case now.
Gotcha, okay. So there's some kind of, I like this question. So we think, of course, Canada has one of the biggest opportunities right now to really shine and we want to get it right, so the world sees that our ecosystem can handle these listings well and well into the future. Right, like one of the things that was noticeable is on the TSX Ventures is less listings, market caps are quite a bit higher though, in fact, like the numbers are bigger, but there's just less, new listings, but overall, but it was noticeable at the TSX, and I know that's not necessarily your day-to-day, but those listings are quite down, comparatively to the venture. Is there anything happening there where the world is not as attracted to the main board? Like any thoughts there? What's happening?
So in terms of just kind of Canadian listings versus kind of global listings, is that kind of the question? Is that kind of where you're going?
I guess so. Is it comparable to global even maybe, or?
Well, I mean, I would say that like listings is increasingly a challenge globally. You know, it's a global phenomenon. I would say on the venture side specifically, we see fewer of what I call like the junior issuers. So like 10 years ago, you would see a fair number of issuers in the mining space go public raising $600,000, $800,000, you know, and those are like the junior issuers, which is not a defined term on securities law, I understand, but it just kind of represents a really small fish. And we still see those, but we see those very sporadically.
Yeah.
And so that kind of feeds into the whole kind of average market cap too, right? So the companies that are going public, they're raising 3 to 5 million now, plus on the TSX Venture. And that's partly to do with the fact that just the cost has gone up.
Yeah.
Right, so if you're raising $800,000 and your fees to go public are $450,000, like it just doesn't make sense, right? And so that just kind of speaks to the impetus too, just to kind of, for everyone kind of see what we can do to like make sure that there's lower costs basically, right? I mean, it's an inflationary environment we live in, everything's going up, right? Audit fees, legal fees, you know, we revised our own fee policy recently, but like it is a challenge for the smaller issuers, I would say. And I mean, that feeds a lot into like the overall drop in the number of issuers on the TSX Venture specifically.
Yeah, okay. Okay, I wouldn't mind talking a little accounting for you accountants out there who are very excited about IFRS 18, because if you noticed, you had quite a few slides there. And if Anita has quite a few slides on IFRS 18, to me it means it might be more significant than it first seems. You know, it also seems like that's the biggest change we've had in a while, right? For IFRS, you know, I remember when we went from Canadian GAAP to IFRS, probably like 15, 17 years ago. It was also at a time when the market was going up. I think that made life somewhat easier for people. How major is this thing? Like, you were talking about performance measures in the financial statements, and those need to be prepared, and what we got to audit that stuff too? Like, how big is this going to be, Anita?
I think like everything, it depends on the particular facts and circumstances. I will say, I do think for many venture issuers that have one operating business, they're in mining exploration, whatever it is, it might not be significant. A lot of the work will have to be done this year for your auditor to document your judgments. I think that's the significant change for IFRS 18. The final product might not look very different, but how you get there are certain judgments companies have to make to explain why this presentation is the most useful structured summary of my operation. So I think that's an area where there might be work that many entities might not realize, because as you say, the end result might not change that much, but getting there might be more work than people expect. On the management defined performance measures, we don't expect many venture issuers to be impacted simply because you need, an NPM is a non-GAAP measure of income and expenses, so even if you were disclosing a non-GAAP financial measure, those might be like an adjusted cost, there's no income basis. So I think on that aspect, there might not be changes in the financials. But again, because the definition is and measuring your public communications outside your financial statements. That work will need to be documented as you come up to the year-end audit, because I don't know what the audit program will look like, but I assume there'll be a step. Do you have management defined performance measures? What were the checks? So again, I think it is the spade work this year to get that in place, and moving forward, I think it's not going to be old Canadian cash back for us.
And just sticking to a little bit of accounting, maybe Mike or Jeremy could think about this a bit. I think you talked about this whole goodwill impairment day one thing, which we've been struggling for a little while with. And Jeremy, you said that one of the risk factors out there in 2026 is fraud, which I think tends to roll over most year to year. So there's a couple things that have been happening for the last few years. Like if I think about all your organizations here, you have done your best to make it easier. Sometimes it's with respect to listing. CPAB, you mentioned that findings are down this year, and hopefully that's a result of auditors being more experienced and doing more quality work, et cetera, as well. I think also you have taken the time in the last couple of years to look at the smaller firms and put a bit of a focus on it, so I think you've done a step back too, to help. Now that the market has recovered somewhat, are we back at risk again? Because, you think about the life offerings, we don't get that many calls anymore for due diligence because they don't need us like they did before. So it's simpler for them, which is nice. Same thing with policies at TSX. So given that we spend so much time trying to scale back and make it a little bit easier on everybody to go public, now that the market has turned, what are some of the risks, whether you want to touch on fraud, whether you want to touch on goodwill impairment on day one, which means overpaying for something potentially? How are we going to deal with this? What's going to happen, Mike?
Thanks, Rez. So when I talked about fraud earlier and the fraud thing that we identified in our inspection report, really it's auditors needing to have that skeptical mindset. And so when transactions are entered into, and maybe there are more transactions coming up because of the market, it's up to the auditor to really have that skeptical mindset and to understand what is the business rationale of a transaction. Why is the company entering into that transaction, which in some cases has been missing. And if you look at our risk alert, there's other factors that we noted that often lead to the issues. So for example, there could be a complex structure in terms of how the transaction is arranged, and the auditor doesn't know why it was structured a certain way. There could be certain situations where there's undisclosed related party transactions, which the auditor didn't consider as part of the fraud risk considerations. Other situations that we've seen are just misleading disclosures, consistent with what Anita was saying. And considering all of that in total, are there potential fraud risk considerations that the auditor needs to be aware of? So I think auditors always have to have that top of mind. And for those in the audience, when you do enter into these transactions, it's important that your auditor be asking you those types of questions to really understand the nature of what's being acquired. All these kind of unusual circumstances that we have in the risk alert should be top of mind for the auditors.
Yeah, because what happens is, especially in markets where stocks are up, auditors often use the market price of a stock to assess what was paid to acquire something, and then often you have startup entities, newly formed companies. All of a sudden you've got this big number on the balance sheet, and then the standards say, well, you've got to look at that number and test it. And it's difficult when you're a startup or a nascent industry when you don't have a 5-year operating cash flow history and so forth. So it seems that challenge was kind of resurfaced again a bit. And really what we're looking for is not to tell you how to do your business. It's more we're asking you, is there related parties? We're just trying to make sure that the stock was issued to the appropriate people, the arm's length transaction that the company did the business with. How about from the BCSC perspective? I'm going to throw one more question because this microphone I'm going to pass back and forth. Maybe you can also comment about what's going on with ESG reporting, because I haven't heard a lot about that lately.
Maybe I'll just take give ESG to Anita. She's probably thinking, wow, he's gonna take this, this is awesome. I don't have to talk climate, I don't have to talk diversity, but, you know, I just maybe wanted to put a commentary to the market. I think what we see in BC is the market itself goes up and down, but the players tend to be consistent, and just, it's like the story changes, right? We think about nascent industries, they're always there, right?
Yeah.
They're just different. So, you know, we're always thinking about our focus on disclosure. Obviously, we have a large part of our commission that focuses on fraud and enforcement. But from our perspective in corporate finance, we're always looking for the application of securities legislation as it relates to nascent industries, whether we went from cannabis to crypto to, you know, these problematic transactions. We're always trying to stay in the forefront of disclosure. So it's just wanted to throw that commentary out there, because I think when markets get frothy, it's not that these things emerge, they just seem to be more magnified, if that's the case.
The numbers are bigger.
Yeah, it's like the work never goes away, it just gets different. But I'll pass it along to Anita for the ESG.
And for your team, I don't know if I'm misspeaking, I think part of some of these transactions is we're trying to use technology and insurance to do more real-time reviews, so we catch them early so that by the time the auditors come in, it hasn't been sitting there for 9 months or 10 months too. So I think that's part of us navigating as the players stay the same and people come up with new ideas. That's the way we're trying to manage that as well. On ESG, you might have seen that in April of last year, the Securities Administrators did issue a news release announcing a pause to the development of the mandatory rule on climate-related disclosures, as well as amendments to the diversity, governance, and disclosure regime. And that pause was announced to provide the market with certainty that no new rules would be introduced during this time. And you recall in April last year, I think, might have been a couple months late, but the tariff uncertainty, geopolitical risk, all these things. So it wasn't the time to introduce new rules. At the same time, we still know climate-related disclosures. It is a priority that's listed on our CSA business plan that was published in the summer. So while we're pausing the development of rule, we continue to monitor developments in the area. We also, in that same news release, highlight that climate-related risks are mainstream business risks. So they're applicable to your company and material. They already require disclosure under the current regime. So that's something I think is important for entities to realize. I think we'll continue, similar to everything else, we'll continue to monitor international developments. We know there are certain investors that continue to request information. So we're looking to see how companies are reacting to that demand, and we'll assess an appropriate regulatory response. But if anything changes, we anticipate providing the market with sufficient notice of any change to priorities. So if materials don't have to disclose, I guess is the message.
Yeah.
Okay, great. I'm going to end up by asking everybody the same question. We have about 8 or so minutes, and then we'll wrap it up, if that's all right. And this is, I like this, given Anita's holistic start to the day here when she read people.com on transformation, right? In looking at your organization, I'll answer it too. What do you think you should do more of, less of, and keep doing? So, you know, our firm at Davidson, many of you know, we audit many reporting issuers on the venture. We've been doing that for a long time. You know, what we're doing now is seriously looking at our investment in technology, including recent hires of financial analysts, application managers, so that our audits utilize the best tools that are available out there for us to make these audits efficient. So we're definitely starting to do a lot more of that. What we're doing a little bit less of is expecting the new generation to work as hard as us. Because, you know, we try, and it's just a different mindset. So, you know, we're stopping assuming that and trying to use different inspirational tools for them to get engagement up so that they feel their work is meaningful and thereby hopefully working hard, which is not a bad thing. And what we want to keep doing is not forgetting where we came from, as Jenny Lopez used to say. We want to service larger companies, and we want to service the small companies too. At our firm, we are very much in favor of keeping that, and by doing so, we're segmenting some of our public company business to ensure that we can serve all. That's what's happening in Davidson. Who's could volunteer to answer that question about your organization? Anita, you seem keen.
Oh, sure.
Are you? Okay.
All the disclaimers still apply, right? But I would love, I really like how Mike and his team approach semi-annual reporting. So I'd like us, it's a start and a stop, which these always are, but I'd like us to stop as jurisdictions try to get to perfection before trying something, to try to make our markets more efficient, to get fit standards or policies that are fit for purpose for the Canadian market. So I'd like us to be more nimble and consider more blanket order approaches, see if it works, if not, then calibrate. So I think that's what I'm looking forward to for the next year.
Then I guess I get the less. But I think the more and the less are almost similar in our world. I think we have to do less of thinking like we used to. I think our marketplace, our environment, be it economic, geopolitical, is changing so much and so rapidly. I think we have to do less of thinking of how did we develop rules, how do we regulate, and some of the things that I think we will hopefully continue to do the same is to ask questions and listen to stakeholders, because I think that's key for us. I think when we're trying to think about direction. Sometimes there's things we can do nimbly and other things that are more politically driven. Maybe do the national regulator kind of concept, but things like that where it's just out of our hands. But I think it's less of the old way of thinking and more of the just thinking of what we can do in a different way.
Yeah, and I guess one of the things that we continue to challenge ourselves is the risk focus that we play. And so if I think about last, one of the areas that as we see the firms mature in their system quality management, being able to change our focus and focus more at the quality systems level, the firms have less, in some cases, less files that we're looking at, which I think reduces a bit of the impact on the audit firms and the burden around that. So that's one area of focus we think about less. I think the area as far as more of, I really appreciate this session here, because when I think about audit quality has all of the different aspects of it. It requires people from a management, CFO, controller perspective, having the right controls and processes in place, getting that to the auditor, having the auditor do all the key work. Those from a governance perspective, audit committees and directors overseeing, and then us playing a role. So the more we can get this kind of group, which is multi-stakeholder together, talking about that, I think is really important from promoting audit quality. And so we encourage any outreach that you're interested in reaching out to any of us to have that conversation, continue that discussion.
Well, when is Andy changing his LinkedIn profile, by the way?
I'll talk to him about that after.
Mr. Presidente. Maybe he's just not used to it.
Okay, so from our side, TMX Group, so one of our core values is being client-centric, and there's definitely been a push the last kind of 3-4 years to really put ourselves in our client shoes, have a real kind of customer service orientation, and so we definitely want to keep doing that. So we've had various trainings around that for staff. And just really putting ourselves in our client shoes as they come to us as listing applicants, especially. In terms of stop doing what I would hope although it doesn't happen as much in 2096, is training. We've done a lot of training. The combination of just really busy markets, we had some unexpected departures last year, so it's just been a lot of training for quite a while. And it would be good to kind of just have a trained up team that kind of that remains, yeah. So,
Great.
yeah.
I very much appreciate the forthcoming and transparent. It's kind of all of you to share some of that. That pretty much wraps up our session. Really thankful for those who came, so many familiar people, new people. We really appreciate your support for Davidson. We're here to stay. Very proud to serve the Canadian public markets. Thanks again to all of our speakers who have taken their time here. The slides and things are going to be available, I think, in about a week online. They've kindly also shared their contact information. Assumingly that means that you can follow up if you have a question or two to any of our speakers. I don't know, Bahar, sorry, did I miss anything else? I think we're good. So have a great year. Stay focused, stay healthy. Looking forward to a successful market for the next couple of years.